name is Joe Corio. I'm the Senior Vice President here at URL Insurance Group, and we're very happy to have you on board today. And I want to, first of all, thank you for the business that you do here through URL. We truly appreciate your support. We know that you have a lot of choices as to where you place your annuity, life, and health business, and we do appreciate you working with URL. And our promise to you is that we'll do everything possible to continue to earn your business. For those of you who are new to us, welcome. URL is a full-service brokerage. We offer a full line of annuities, both fixed and indexed, single premium life products. We also have a traditional life portfolio. We do individual and group health products, and we have a senior division for MedSup, MedAdvantage type plans. So please feel free to check us out on our website. We feel it's a cutting-edge website, and the address there is urlinsgroup.com. Okay, we're very excited about our program today. We have a very special guest for us to make the presentation. And basically what's been happening in the industry the last 12 to 18 months, there's a lot of what I call sideline money out there, and that might be money that's sitting in savings accounts or CDs making next to nothing. Or maybe they're in mutual funds that are doing the roller coaster for your clients, you know, up one year, down another, up a year, down another, and at the end of a 10-year stretch, you're basically where you started 10 years previously. So that's a lot of what I call sideline money, and we're seeing a lot of that go into products such as single premium life, especially as people reach their retirement age and beyond, because they want that money to work harder for them and smarter, and that's where the single premium life comes in. One of our top carriers is Baltimore Life, and Baltimore Life has two great products that fit the single premium mold. And we are fortunate enough today to have Mr. Gary Voith with us. Gary is the Vice President of Corporate Marketing at Baltimore Life, and he is going to review the products and to discuss how they can benefit your clients and also benefit you. So without any further ado, I'm going to turn the program over to Gary. Do a little trick on my computer here.
Well, thank you so much, Joe, and good morning, everyone. Appreciate, again, the opportunities Joe mentioned to have a chance to talk to you and to learn more about Baltimore Life's asset transfer products. I'm going to set up my screens here, and hopefully, Joe, you can confirm for me that you can see everything they need to see, right?
I can see it.
All right, fantastic. We're going to talk today about Baltimore Life's tax-efficient asset transfer program. We're going to spend a little time talking about product, the market, but then we're going to get into some sales and marketing ideas to help support you along the way. Certainly, the key thing I do want to reinforce is that, you know, we have a very select group of marketing organizations we work with. We take a lot of pride in making sure we have a small group, and URL is one of our top marketing organizations for this product line. So they offer a great support for their agents, and we know that if you have any questions as you're trying to tap into the market, make sure you pick up the phone and call URL. The two products we're going to talk about today are Generational Legacy and Single Premium Whole Life. Both these products are really designed for your senior clients in mind who have some sideline money, as Joe mentioned. We like to call it leave-behind money. But either way, it's money your clients want to leave behind to the next generation, do it in a tax-efficient way, and ultimately increase the amount of money they can pass along to the next generation. Let's talk a little bit about this asset transfer or wealth transfer landscape. It's about $1 to $3 trillion per year that's being transferred between now, and it's projected all the way out until the year 2052. We know that about 55% of your clients' wealth is moving on to their family members, and 16% of their wealth is moving on to their favorite charities. So yes, 71% of your clients' wealth is moving on to people and organizations they know and love. The question really is, are they maximizing the amount of money they can pass along, and are they doing it in the most tax-efficient way? Well, the first product we're going to talk about today is Generation Legacy. And Generation Legacy is a very unique product in the market because this single premium product is designed to take single premium funds originating from non-qualified deferred annuities and other qualified funds, 401ks, IRAs, 403bs, and the like. And of course, this is ultimately money not needed for daily living. That's sideline money, as Joe had mentioned. It helps your client leave an estate for their heirs and favorite charities, and ultimately with that single premium, increase the amount of estate value they're able to pass through tax efficiently with the use of a life insurance product. The issue ages for Generation Legacy are ages 60 through 80, and this product very uniquely combines with a single application you're going to write two products that will be issued and seamlessly administered together by Baltimore Life. Those products are a single premium immediate annuity that will receive the transfer of funds, combined with a limited premium payment whole life product that SPIA will pay premiums on over a short period of years. And we'll talk about how that works. This product also is featured with a simplified underwriting process, as well as our accelerated death benefit rider, which truly can provide living benefits to your client at a time when it's needed most. So a little bit on the qualified market, about $2.3 trillion of in-force deferred annuities out there. About 60% of that money are in the tax-qualified plans, such as the IRAs and 401ks, but 40% of those funds are out there in non-qualified deferred annuities that I know agents of URL sell a lot of. As you probably know very well, a significant share of this money is not being annuitized. It's simply accumulating and ultimately being transferred to the next generation by your client. Of course, if they have qualified funds and they're sitting on it and they don't need the income, they do have required minimum distribution rules starting at 70.5. But ultimately, if they had, let's say, that annuity that they had no plans of using for income and they just want to pass it, who are they passing it to? They're not only passing it to their family members, but they're also passing the taxation along to their family members who are going to receive those funds. So if their only goal is to pass the money to the next generation, my question is an annuity the best product to die with, or is there a better solution? Well, we feel as though Generation Legacy can be a great solution for a significant percentage of your clients that have these deferred annuities and have no plans of ever using it for income. Let's think of a single premium product as conceptually as a gift they're going to be passing along to the next generation. And inside this gift box, you're going to be helping your clients transfer money from qualified plans or non-qualified deferred annuities. Inside the gift box with a single application, we're going to issue two products, a SPIA along with a limited premium payment whole life product. And of course, the SPIA will be receiving the transfer, the initial transfer of those funds from the annuities. Now, over a period of either 7 or 10 years, depending on the issue age, the SPIA is going to make annual premium payments to that life product. So the issue age does dictate the payment pattern. So if a client's 60 to 74, we'll issue a 10-year SPIA along with the 10-year life product. The client's 75 to 80, a 7-year SPIA along with the 7-year life product. But here's another very unique design portion of the Generation Legacy product. It's the death benefit. What happens if the client were to die during the period while the SPIA is used to pay annual premiums on the life product? Well, we know that the life insurance, no matter when the death occurs, will pay an income tax-free death benefit that's significantly greater than the single premium paid. That always is going to happen. But during the period of years while the SPIA is around and death occurs, any remaining payments from that SPIA that weren't used in the 7 to 10-year period to pay for the life insurance will ultimately then be paid out to the beneficiary. And that's a very unique design feature out there in the marketplace right now. So their beneficiary is getting both, the life benefit as well as the remaining payments from the SPIA. We'll talk more about those payouts of the SPIA from a taxation portion a little later on. But the life insurance, of course, is always income tax-free. Now, at the end of 7 or 10 years, the gift box conceptually is complete. It continues to provide an income tax-free death benefit, continues to provide cash value accumulating on a tax-deferred basis, and yes, continues to offer the accelerated death benefit riders we're going to talk about. So just to recap, issue ages are 60 through 80. We base our pricing on current age or age at last birthday. Now, the reason this is important is that when you're setting this product up, you're transferring funds from other institutions and products. That transfer process could take 20 to 35 days, let's say, but when we ultimately receive the funds, we will issue the client based on the age they are the day we receive the funds. The minimum premium to get started on this product is only $5,000. How many annuity clients do you have out there that have $5,000, $10,000, $20,000, $50,000 annuities that they love the fact they're getting good growth, it's tax deferred, but they have no plans of ever needing it for income? If you ask those clients, Mrs. Jones, what is your goal with the money? And she tells you, I just want to pass it along. Well, quite honestly, this can be a great option to show them. The average premium, by the way, we see on this product is $60,000 to $65,000. Now, the maximum face amount that we'll issue for the life product based on the single premium is $450,000. We have two underwriting classes through simplified issue, either non-tobacco or tobacco, and we'll issue any risk standard through Table 4 in these underwriting classes. Cash values accumulate. Yes.
Yeah, I just want to point out, if anybody has any questions here, please don't hesitate to type in. There's a pane on the go to meetings pane. You can type in a question and we'll answer it as we go along.
Yeah, absolutely. And please ask the questions. That's the way everyone wants to learn. Cash values, they accumulate in the life product on a non-participating basis. Partial surrenders, they are permitted from the life product after the life product has become paid up in either 7 or 10 years. Loans, though, are available at any time from the available cash value at a maximum interest rate of 8%. So now let's talk about those accelerated death benefit riders, because truly they are providing living benefits. The key thing to remember is that long-term care insurance is still the best solution for a long-term care need. But as you know, many senior clients cannot afford the premiums for long-term care insurance. So isn't it nice to know that you can accelerate the death benefits of a life product in certain situations? Well, those 3 health event triggers that we provide them the chance to accelerate the benefit are terminal illness, confinement to a qualified nursing home facility, and in situations of extended care, home health care, and adult daycare. This is obviously increasing the liquidity of the life insurance face amount, and upon the decision to accelerate, which can happen anytime after issue, we would basically create a lien against the death benefit for the amount taken, and that lien would accumulate at an annual interest rate of 8%. The maximum they can accelerate is $250,000. The minimum is $5,000. But here's the good news. The benefit is paid out once. It's paid out in a lump sum, and these are non-restricted funds. The client can use this money for whatever purpose, reason they might need those funds for at end of life. Now let's take a look at the definition of these health event triggers and the percentages of payout. The first one is terminal illness. Simply put, the client needs to be terminal with a life expectancy of 12 months or less. And in this case, they could accelerate up to 75% of the face amount. For the qualified nursing facility confinement, they need to be chronically ill, confined to a nursing home for at least 90 days with the expectation of a permanent confinement. Here again, they can accelerate up to 50% of the face. That extended care provision, the client needs to be chronically ill, been so for 90 days, but now requires care provided by a licensed home health care agency or a licensed or state-certified adult daycare center. And here they can accelerate again up to 50% of the face. Now in the state of Pennsylvania, which I know many of you might be, those percentages are a little less, 65% for terminal illness and 40% for the nursing home care and the extended care. Folks in Indiana have a similar percentage. But the key thing here is these riders are really designed and priced to be able to provide cash now and still have remaining death benefit in most all situations. We talked about chronically ill. What's the definition of that? Very similar to what you might know. If the client satisfies either of these definitions, we consider them to be chronically ill. The first one is they can't perform 2 out of 6 activities of daily living. But maybe they're okay on their ADLs. Possibly they could be suffering from a severe organic mental illness, such as Alzheimer's or dementia. In either case, we consider them chronically ill. So let's take a look at some examples of how this rider actually might work. And here's an example if a client has a face amount of $100,000 with a terminal situation. So they're terminal. They can maximize at 75%. So if they do that, they're getting a check up front while they're living for $75,000. And when we do these transactions, we do add a $100 service fee one time for getting that payment paid. But if that client would die immediately after getting their check, no time for interest to accrue on that lien that they've created, the remaining death benefit would be $24,900, which is just the face amount less the original lien. But the more practical example is this one, and that is that the client lives 1 year after getting the check of $75,000. Now the remaining death benefit would be $18,892, which is the face less the original lien plus 1 year's worth of interest. So obviously you can see the rider is designed to give cash now, still have remaining death benefit in all situations. This client would actually have to live over 4 years being in a terminal situation for the interest to outrun the remaining death benefit. Pretty impractical to see that even happen, right? And that's why with with nursing care and extended care, we set those percentages at 50%. So when would the riders actually terminate? Well, one of them I want to point out is very important. What if the whole life policy ends? Obviously, the riders would terminate, but how could the whole life policy end if the SPIA was paying premiums on it? Well, here's how that might happen. Let's say someone gives you $100,000 to start this out, and it's leave behind money, and it's a 10-year type of payment plan from the SPIA to the life product. Well, 2 years into this, they come back and say, well, you know, Joe, I thought this was leave behind money, but I really need the income right now. So technically, these are still two contracts. You could decouple the life contract, cash it in. It would have very little cash value at that point. But then we would make 8 more years of payments to the annuitant in this case to receive that income that they dearly needed. So that would stop the accelerated death benefit riders. Obviously, if the client dies, we pay a death benefit instead. And the other thing to remember is you can only accelerate these riders one time. So if you accelerate it under the nursing home provision at 50%, you can't accelerate again. Now, in the very unlikely scenario that I exampled earlier, that if the interest outruns the remaining death benefit, technically the life policy could end, right? And in that situation, that would be odd, the owner may repay all or part of the lien at any time if they want to keep it qualified as a life product. Keep in mind, even though you accelerate these benefits, there's still cash value there accumulating in the life insurance product. And if for some reason you have a loan existing on the policy, you cannot accelerate the benefit at that time. You either have to have a loan or a lien. You can't have both. The last thing to remember, no matter if you're accelerating under our benefit or any company's similar benefit, you should always tell your client to consult with the tax advisor. So here's some quick examples of these payouts. And hopefully you're looking at this on the screen. It's a 70-year-old, puts $50,000 in, and they have a death benefit issued of $78,000, nearly $451. But look at those accelerated death benefit payouts. That's truly real money to a senior client who's at end of life who needs cash to help with whatever need they might have for that cash. And of course, even with that, they'll still have remaining death benefits. So we know about the tax efficiency of the life insurance, income tax-free death benefit greater than the single premium paid. What about the rollover money? Well, if you're rolling over an IRA has never been taxed before, so eventually Uncle Sam has to get paid, right? If you're rolling over an annuity into this product, there's a cost basis and then a gain. Well, the gain eventually has to be taxed. So no matter which type of vehicle you're working with, you're going to transfer money into Generation Legacy, and it goes in the SPIA. And since the SPIA is going to be used as premium payments over a 10 or 7-year period for the life product, we're able to spread that tax on the gain out over the same 10 or 7-year period. So, of course, the policy owner will, with this product, receive a 1099 each year for the taxable portion. The good news is that the payment we make from the SPIA to the life product does satisfy the RMD rules. That's a good thing. And the other thing to remember is that if for some reason death occurs during the years while the SPIA is around paying for the life insurance, we know the life insurance is income tax free, but those remaining payments from the SPIA, of course, to the beneficiary would be taxable for the portion that's never been taxed before. Now, the default method we use to pay out those payments of the SPIA are the remaining annual payments. But if the Benny says, you know what, I want a lesser commuted lump sum of that money, we'll do that. In either case, though, we get a 1099 based on the distribution. One more important thing about tax, it relates to the application. Any time we're rolling over qualified funds, we have to ask the question, do they want tax withheld? We have to ask the question, but the way this product is designed is that we cannot issue the product if they want tax withheld. So please make sure you check on the application. You do not want tax withheld from the annuity you're rolling over, or we have to send everything back to you. So here's some examples of premiums to death benefits, and I want you to be thinking now about some of those annuity clients that you have out there that you know have money they're sitting on, no plans of ever needing it for income, and they just want to pass on an estate. Can't they do much better in these examples I'm showing you? 65-year-old, non-tobacco, who has a $50,000 CD, let's say. Because they're 65, we're going to issue a 10-year SPIA along with a 10-year life product. The male, we get a face amount of $77,361 and change. The female, a face amount of over $87,000. So what did you just do for this female 65? You immediately increased, just with the life insurance, her estate by over $37,000. Not forgetting that if she dies in the first 10 years, the remaining payments from the SPIA would also be paid to her named beneficiary. Now, she may say to you, Joe, what if I keep this money in the annuity and I'm making 3% on it and a marginal tax bracket of 25%? It would take her over 19 years just to accumulate the $87,000+ that would be paid out from the life insurance product. Not forgetting that if she decided to put that money in a taxable investment, it would take her over 25 years to do the same thing. Keep in mind that life insurance benefit of over $87,000 will always be there and be paid as an income tax-free death benefit to her family. Here's the 75-year-old, little older, a little shorter life expectancy, but the numbers still look good. The same 50 grand going in. Because this client is 75, we'll issue a 7-year SPIA along with a 7-year life product. For the male, the face amount would be $61,516 and change. The female, over $67,000. So at 75, you still increase the lady's estate value by over 17 grand. The male, almost $12,000, knowing that the remaining payments from the SPIA could also be paid. I'll tell you this, what we've experienced with agents through the years selling these products is that once they make these sales, your senior clients, when they have their coffee at McDonald's or their breakfasts at the Bob Evans with their friends, this is what they talk about. They talk about how their agent took some sideline money and helped them pass on a much greater estate for their family members and did it in a very tax-efficient way. What that's going to do for you from a marketing standpoint is create a great opportunity to be asking for referrals on a regular basis. Okay, here's an example of a ledger that would come out with our proposal software or in our mobile link software, which you can use right on your phone, that kind of shows the ebb and flow of how the cash works on the Generation Legacy product. This is the female 70, non-tobacco, who has an annuity they're rolling over of $50,000 with a cost basis of $40,000. You can see in column 3 the single premium going in of 50 grand, but you see that each year from that 50,000, a SPIA would make the payment to the life product of $5,570 a year. Out of that premium, nearly $4,000 of it is excluded from tax, and the client would get a 1099, the estimated taxable income portion, of course, of $1,500, nearly $71. The ledger goes on to show the life insurance death benefit of $78,451 and the annual commuted lump sum death benefit that would be paid at a point in time from the SPIA. So this really helps you see the ebb and flow of the money, and it really helps the client understand how the product works and makes them well aware of the 1099 they would receive. Now, what about forms? How do we make this easy? Well, out on our agent website, you will find every product you're contracted for with us. You will have a corresponding product toolkit. And in these product toolkits, you'll really find everything you need to sell and market our products. I'll talk about some of that later on. But we have an application and forms package. You go in, you answer a couple of quick questions, and it's automatically going to populate for you the forms that you need. You can print the forms locally, you can order the forms from us, or you can email the forms, whatever you might need to do. It makes it pretty simple. We also have in that forms package a set of instructions which takes you through how to submit your business, and more importantly, gives you the key information, phone numbers, times to call to complete your point of sale underwriting interview. That's where in a short 12-minute interview, we're going to be able to give you an underwriting decision right at point of sale over 90% of the time. So before you even worry about transferring funds from another institution to us, you'll know over 90% of the time right there before you leave the home exactly what the underwriting decision is. That's what live underwriting is all about with this product. In that product toolkit, as I mentioned, we're going to show you some of these other things later, but we've got letters, phone approaches, customizable marketing flyers, mobile app tools that you can use, point of sale presentation pieces. We'll show you some of this later on. So now let's talk about the second product, and that's our single premium whole life product. I noticed Joe in his ads on his website for URL talked about April being CD rollover month. It is a big month for CD rollovers because many of your clients who had tax refunds started CDs around this time of the year. So it's a great time to be prospecting in the after-tax cash market, right? One of the key differences with our single premium whole life product is the origin of the premium funds. And these are coming from after-tax cash vehicles such as CDs, money markets, mutual funds, and where appropriate, 1035 life-to-life product exchanges. Same goal, client wants to increase their estate and do it in a tax-efficient way, but here's another key difference. The issue age is 50 to 85, a little broader. We also have simplified underwriting on this product through 8 tables of underwriting. We'll talk about that. And we also have that same accelerated death benefit rider in all states where it's approved. The key thing on this rider with this product is we have the same health event triggers to get your money, but this has a more lucrative way to get the money out. The client could either elect to take as much as possible and have no remaining life insurance, or keep a certain amount of life insurance and accelerate the balance. So 50 to 85, again, based on current age or age at last birthday or the issue ages, we have 2 tiers of underwriting. Level 1 is standard through Table 4, either non-tobacco or tobacco, but we have that Level 2, Tables 5 through Table 8. So for your insulin-dependent diabetic clients, you're going to be able to have this product available. It really fits in so many great opportunities. Premium, minimum premium, again, it's only $5,000. How many clients do you have out there that you're doing fact finds on? Are you finding the 5s, the 10s, the 20s, the $50,000 CDs that are set up? And you know, that it's leave behind money. Seniors compartmentalize their funds. Here's the money for the kids. Here's the money for the grandkids. Here's the money for the church. How often do you run into this one if you're selling, let's say, life insurance to a senior? You're talking to Mrs. Jones. She's 70, and you say, Mrs. Jones says, "Well, Joe, I really don't need any life insurance. I have a burial account set up at the bank, a burial account." And you say, "Okay, a burial account. What's that mean?" Well, it means one of 2 things. It's either a prearrangement at the local funeral home, or it's a CD that Mrs. Jones has set up down at the local bank for $15,000 that the kids know, her kids know, that's the money set aside to bury her. Well, Mrs. Jones, you're 70. You're going to live many more years. What if I was able to show you a way to take that $15,000 and maybe provide you with nearly a $25,000 income tax-free death benefit? Oh, by the way, if you became terminal in a nursing home or an extended care situation, you could get at some of those funds to help with your end-of-life expenses and still have some remaining death benefit. Oh, by the way, this contract also has some very liberal partial withdrawal features starting in the second policy year, and I'll review those with you. So that's a quick concept we call the burial account concept, and so many agents that are getting started in the business find a way to start selling single premium in that way. Once they figure out that how nice these sales are, they start doing more thorough fact finds to find the money, because single premium business is all about finding the money. By the way, the average premium we see on this product is $30,000 to $35,000. The maximum face amount for the product is expressed in terms of the maximum net amount at risk, and that's just the difference between the face amount that we issue and the premium the client paid. That difference, that gap in between, is the net amount at risk, and here are your maximums. It takes a lot to hit these. Cash values, they accumulate on a non-participating basis. Here was the other key difference that we talked about. Partial surrender capability starting in the second year. So if your client says, yeah, Joe, this was leave behind money, but God forbid, what if the sky falls? Can I get at my funds? Well, starting in year 2, you can take a 10% partial withdrawal, 20% in year 3, 30% in year 4. In year 5, it's 40%, and from the 6th year on, it's 100% of the available cash value. Loans, they're available at any time, but I really don't know why you would take a loan when you have such liberal partial surrender capabilities. What about the accelerated death benefit riders? I mentioned the same 3 health event triggers you can use on this one as you have for Generation Legacy. This also is paid out once. It's not, the funds aren't limited. You can use it for whatever reason you might need to. But with this product, you can either get a full acceleration and leave no life insurance behind, or do a partial acceleration and have some death benefit left over. So here are those percentages. For a terminal situation, it's the same definition to qualify, 12 months or less to live, but the client could maximize their accelerated benefit at 95% of the base amount, let's say $250 admin charge. Have no remaining life insurance, but they got most of their death benefit in advance. For qualified nursing home confinement, same definition to qualify, but because they're going to live longer, the maximum acceleration rate is 90% less the $250 charge. For extended care, you're going to live longer yet, so the maximum acceleration rate is 80% less the $250 charge. Or again, do a partial acceleration, leave some life insurance behind, and accelerate the balance of the face left over at 80% less the admin charge. What about the chronically ill definition? Same definition as we talked about Generation Legacy. 2 out of 6 activities of daily living, or someone suffering from a Alzheimer's or dementia type situation. So here are those premiums to death benefits, and again, I want you to be thinking about those prospects, clients out there that you're doing fact finds with, you have in your book of business, people you meet that are setting up these little CD accounts, these leave behind or sideline accounts. $50,000 in premium would yield a male for level 1 underwriting a death benefit of almost $82,000. The female, death benefit of nearly $93,000. But don't forget, with single premium whole life, we have that second tier of underwriting, tables 5 through 8. The death benefit reduction you will see across all ages and genders is like $5,000 to $6,000. So it's not much of a reduction to have that second level of underwriting around. So what did you just do for a female 65 with this product? You increased her estate value by nearly $43,000. This was sideline money. She had no idea she could do something like this. She was just sitting on it. I was mentioning to Joe before we started today, I had a neighbor of mine who's a multimillionaire next door to me who was setting up a couple of CDs for grandkids. And I said, let me ask you, what's your intent with the money? They said, oh, we just want to kind of set up a legacy for them. And I start getting into the single premium concept, and they said, really? How much more could I leave behind? Well, I pulled out my phone, and I went to our mobile link software that I'll tell you about, and immediately was able to give them that answer. And they were so impressed, guess what? They became Baltimore Life clients. So you're looking at a great increase in their estate value, and they say, well, what if I left the money in the CD? Could I do better? Well, if they were in a 25% tax bracket making, oh, good luck, 3% interest on a CD, that's not out there right now. It would take them 28 years just to accumulate the increase you gave them in estate value, keeping in mind that the life insurance is always income tax free, right? Now, we have a tool out on our agent website that is a CD single premium whole life calculator tool. It's a comparison tool where you can show side by side the money going into the CD and the interest on the money, and then the after-tax impact of that 1099 interest having to be declared. And then we compare it to the death benefit on the single premium product. It happens immediately after issue, right? They immediately get that bump. And if you look down through 20, 30, 35, 40 years, it always shows them an increase in their estate value. So that's a great tool that if you need some help working with the client and showing them very visually how that comparison is going to look, it makes the sale for you. Here's the 70-year-old, a little older, shorter life expectancy, but the numbers still look good, don't they? For the male, at 70, the $50,000 would generate a face amount of nearly $74,000. The female, a face amount of over $82,000. And again, that level 2 death benefit is about a $5,000 to $6,000 reduction. So at 70, you can still increase this woman's face, or her estate value, I should say, by over 32 grand. The male, almost $24,000. Those are real dollars that, again, is going to create a lot of chatter with your senior clients and a great opportunity to leverage that chatter for getting referrals by you on a regular basis. Now, the one thing I do want to point out here is that if you put $50,000 into the single premium whole life product and the same $50,000 for the same person in the Generation Legacy product, the single premium whole life product will generate a slightly higher face amount. And the reason is that with Generation Legacy, we also have the chance of paying the remaining payments from the SPIA. The key thing to remember, though, is that you cannot put qualified funds, annuity funds, into the single premium whole life product. Has to go into Generation Legacy because of that taxable gain and spreading the tax out. So, what about the forms? Again, the forms were same story I gave you before. Go to the product toolkit for single premium whole life, answer a couple of questions, you get your forms. It's all good. We
Gary,
also have plenty.
Gary?
Go ahead, Joe.
The question came up about instead of printing the forms, can they go online for fillable forms?
Oh, an order. Oh, absolutely, yeah. If I didn't say that, just to clarify, you can print, you can order, you can email, whatever you might need to do.
Can you actually apply for and fill out the application online?
Not at this time. That is coming. I'm actually in charge of a project for the company that all of our simplified issue business will eventually be available to you online.
Okay, thank you.
That you'll not only be able to apply online, Joe, but to have that same live underwriting capability online to make a decision. So it'll really be a streamlined process for you we're working on. Okay, so in the toolkit, again, lots of sales and marketing tools. I'm going to show you that in a moment. Let's talk about that point-of-sale decision underwriting process, because this is the icing on the cake. We had so many annuity producers that came with us when we came out with Generation Legacy that said, you know what, I get asset transfer, I like it, it makes sense, but you know what, I hate the life insurance underwriting. What if we could show you a way, Joe, that, you know, right after you finish the app, we can get you a decision over 90% of the time in 12 minutes or less. Would you like that? And that's exactly what point-of-sale underwriting is all about. We basically will interview your client and ask them the same health questions that you completed on the paper app. But behind the scenes, we're firing off right there the data we need from the MIB and the drug history to determine if there's anything outside of how the client answered the question, so we can get clarity quickly and make that decision. So it works very, very well. As soon as that interview is done, by the way, any underwriting decision is given to you, the agent, not your client. So it's up to you to communicate the underwriting decision. And we'll also give you a confirmation number for that call that we asked you to write on the app. So here's some quick phone numbers for the call center, that you see on the screen. I'm not going to repeat these because they all come out with your app package. They're in your mobile link software. They're everywhere. But you'll notice that the hours for the call center, 9 a.m. to 10:30 p.m. Monday through Thursday, 9 a.m. to 6 p.m. on Friday. These are Eastern times. So, we do have English and Spanish languages available. Other languages are available upon request. If you have a hearing impaired client, TTY services are available in English and Spanish. The key thing is that the interview must be completed within 5 days of completing your app. And it's an inbound call. You need to start that call. So you might say to yourself, well, Gary, what if I write an app on a Saturday, or if it's after hours because I'm out on the West Coast? How does that work? Well, it doesn't really matter when you complete the app. You always want to call the call center before you leave the client's home. And the reason is that, you can call into the call center and leave your name and number, your client's name and number, and a date and time you want us to call them. We will call them, complete the interview, and then call you back again with the underwriting decision and the confirmation number. If it's during normal hours, obviously you're going to get it all done at the same time. So the process works very well. We've been doing it for 5 years now. Agents love it. These are our 2 biggest selling products. What about pre-qualifying the apps? Well, we have an app for each product because with Generation Legacy, remember, we have 1 tier of underwriting, single premium whole life, 2 tiers. So for Generation Legacy, because we have 1 tier, it's a Part A section. Think of Part A as knockouts. If you get a yes in Part A, it means your client doesn't qualify through 4 tables of underwriting. But if you get all no, the height and weight looks good, the MIB and drug history look good, we're going to issue Generation Legacy. For single premium whole life, we have 2 tiers, so we have a Part A and B. Still think of Part A as your knockout. If you get a yes in Part A, it means your client's not going to qualify through 8 tables of underwriting. But if you're all no in Parts A and B, drug history, MIB, and height and weight look good, and the prescription drug look good, we're going to issue Tier 1, which is standard through Table 4. If you get all no in Part A, but 1 yes in Part B with everything else looking good, we'll issue Tier 2, which is Table 5 through Table 8. So that gives you a quick overview of the product and the market. Let's talk now about marketing, and let's talk about some of the great support in addition to the fabulous support you get from URL that we provide here at Baltimore Life. We've been talking about the agent website. We've been talking about the product toolkits, right? This is a screenshot of our homepage of our agent website. And at the top of the homepage, you're going to find all those little colored boxes. They represent the product toolkits that will only appear for products you're contracted for. If you click inside of, let's say, the Generation Legacy toolkit, this is what you would see. And all the toolkits have something similar format. You'll see the printable application and forms package there, the state approval charts, agents reference and marketing materials and point of sale materials. We have an on-demand training library and just a lot of other stuff. Let me kind of show you a few of those things that I think you'll find interesting. This is the big one, and that's Mobile Link. I think if any agent doesn't use Mobile Link and they have a smartphone, you're missing the boat on this one because this makes it so easy. You really won't need a paper agent guide. So if you go to mobile.baltlife.com, and that's on your phone, tablet, or computer, anything connected, it will take you to the Mobile Link homepage, which you'll see in that white center panel in the middle. On the Mobile Link homepage, you basically have an agent guide in your hand. You have the product information, the underwriting guidelines, and then most importantly, a rate and value calculator that can immediately provide you with all the ledger information you need to show a client and get that information together quickly. Once you're on that Mobile Link homepage, what I recommend if you're on your phone is hit your settings button, and then it'll give you an option. Do you want to save this page as a link on your phone? And if you do, it's going to create a little shortcut, just like an app on your phone, with one of the Baltimore Life ship icons on it. So when you're in Mobile Link, you really have everything you need to immediately provide the answers right there at point of sale. Also, we have software called Secure Solution Presenter. Secure Solution Presenter is basically like an electronic presentation piece, electronic track book, if you will. So when you download that from our site, and it's safe, we've built it, you'll have all of our product portfolio presentations conceptually. You'll have other financial concept presentations out there to use. You'll have the option to either view the presentation with your client on the screen. You can print it if you want to work with hard copies of things, or you can email it. But here's how those presentations look. Very visually appealing, nice graphics, explains the concept of asset transfer in this case. It gets into key questions you can dialogue with your client about. It then shows the features and benefits of the product. Then with Generation Legacy, we use that gift box concept, showing you how two products essentially work together as one. We show examples. If you put a certain amount of money in, Mrs. Jones, look at the impact this can make on your estate value. We show the accelerated death benefit rider and explain it with some examples. So all that, again, can be found in our secure solution presenter software that can be found right on the product toolkit. All right, let me show you another piece in the toolkit, and that's our asset transfer analysis form. We talked about how important it was to make sure that you're doing good fact-finding, right? And I'm sure all of you have good fact-finding tools, but if you need some help, hopefully this can help you. The center section of the form allows you to record the client's current liquid assets, CDs, money markets, annuities, and whatever. If you shift a certain portion of those funds into one of our products, you can quickly show and illustrate the impact that's going to make on their estate value. The bottom of the form allows you to record their current monthly income, so you make sure they have enough income to satisfy their needs now and going forward. The top of the form has some of those key questions again for you to be dialoguing about that will trigger yeses and point you in the right direction to present this product. One of those questions, for example, is, Mrs. Jones, do you have money that you'd like to leave behind for your family or favorite charities that's not needed for your daily living? And guess what? Most people get that leave behind money concept, and if they don't, it's going to create a great dialogue with you to get into the asset transfer concept. This screen right now is a bunch of bulleted sales ideas that we explain in full detail in a document called Single Premium Sales Ideas that can be found out in the product toolkit. We've talked about a few of these today. What about your book of annuities that you know a high percentage of these people will never use that money as income? Great prospects for Generation Legacy. What about some of those older paid-up life policies where the cash values are close to equaling the death benefit? Whether you're 1035ing 1 or 5 of those policies into a single premium whole life product, it can certainly provide them with a much greater death benefit. What about the old ULs where the cash values are going in the wrong direction? If you can rescue at least $5,000 of premium, you can 1035 that into single premium whole life. And we did talk in the example I gave on the burial account concept. Again, one of the best ways for agents who are especially just starting out that are selling maybe just final expense and small face amount life insurance to get into the single premium business. So when you're reading this document in detail and a full explanation of this and many more sales ideas, have a blank sheet of paper beside you, because you're going to start immediately thinking of people that you can go out and see today and start making these sales. And this product line is contagious. If you start selling one of these a month, not only are you going to make a big difference in your client's life, but a big difference in your income. And it'll become infectious where more and more opportunities will pop up based on your good fact-finding. We have these customizable marketing flyers out there where it explains the concept of asset transfer, features and benefits of a solution, and then you can personalize these documents with your contact information. I mean, I've seen agents print a bunch of these off, download the Secure Solution Presenter software, buy some coffee and donuts, and go down to the local senior center in the community that, you know, that's where they go for computer classes and trips to the casino, and they do a 30-minute stand-up on asset transfer. It works well. We have print ads out there for you to use. We have letters. We have phone approaches, and we have third-party articles. Actually, something that we're going to be adding to the site here in just a few weeks is a new white paper that can be used with consumers on the concept of asset transfer. So all this information, just to recap, can be found out there on the agent website in the product toolkits. So with that, Joe, I just want to promote one thing, if you don't mind. You guys have so many great trips. I'm going to make a plug at saying, hey, if you make Joe's trip, why not make ours too, right? Everybody, it's nice to have some extra vacations. We've got a great trip coming up next year, next May 19th through the 23rd at the Hard Rock Hotel and Casino in Punta Cana in the Dominican Republic. You and a guest, all expenses paid, and what it takes to qualify if you're just doing single premium business is $600,000 in premium. You know, the nice thing about our trips is the fact that we don't have business meetings. We just have a lot of fun. So when it's you and a guest, all expenses paid, you're just there to have fun, and we hope you become one of our guests at next year's trip to Punta Cana. So with that, Joe, I'm going to pass it back to you and really thank you for the opportunity, and thank all
Gary,
of you for spending some time today.
All right, we did have a couple questions here there we can clear up first. And there was a couple in regards to the loan interest rate. And I heard you say that there are ways other than using the loan. So
Sure.
The questions were, it's essentially a loan against the policy at 8% interest and explained as a lien. Could you address that one more time for the folks on the line here, Gary?
Sure. You're talking first about generation legacy. And with generation legacy, when you accelerate the death benefit, you're creating a lien against the face amount on the contract. And that lien is the amount of money that you accelerated or took in cash. That amount of money would accumulate. We would add an 8% interest rate on that lien that would accumulate each year prior to death. So at the client's death, we take the face amount less the original amount of money you had taken, plus the 8% annual interest, you know, that would be the remaining death benefit. Now with the other thing on a loan, because we're talking about two different things here, if you want to make a loan against the policy's cash value, you can do that with a maximum interest rate of 8% per year. With Generation Legacy, you can take partial withdrawals after the life products become paid up, which is 7 or 10 years. Now, in single premium whole life, little different concept there. You can take partial surrenders within limits, starting in the second policy year. You can take loans at any time at an interest rate of up to 8%. But the accelerated death benefit rider on single premium whole life does not work on the lien concept. It simply is, you know, you can accelerate at a certain percentage and have no remaining life insurance, or keep some life insurance paid up over here and accelerate the balance at that same percentage. The reason we have two different methods on the accelerated death benefit rider is really a function of when these products were issued or manufactured, I should say, and filed with the states. Single premium whole life is the older of the two. The lien concept was not in vogue at that time. The other method we used was. But when we filed Generation Legacy several years later, the states were more, you know, wanting that lien concept, and that's how we set it up.
Okay. Appreciate that explanation, Gary.
Sure.
And I don't see any other questions here, so I will leave it with we hope we can help you grow your single premium life sales. Please don't hesitate to call URL, either myself or Maria Adams, and we'll be glad to help you. Our number is 800-926-8875. That's 800-926-8875. And with that, I'd like to thank Gary for being with us today. I'd like to thank all our listeners, and happy sales, everyone. Have a great day.